Before I dive into the collateralization feature of the Index Universal Life Policy, imagine this scenario. You're a business owner and you need a piece of equipment that costs $15,000. This is cash you don't readily have available. You may have it saved in your SEP or your IRA. Maybe you've put most of your money in your house or your commercial building, but it's not liquid. So your only option is to go to the bank and request a loan. If you've ever done this, you know it's not a simple task. You've got hoops that you have to jump through, paperwork to fill out, credit checks. You know the drill. If after weeks of back and forth, the bank determines that they'll give you a loan, they will determine what the interest rate is, how much the payments will be, and what the terms are for paying back the loan. The bottom line is this: you don't have much say in the matter. The lender is in control. You and your business are servant to the lender. This is where collateralization comes into play. Collateralization is about harnessing the power of your money so that you're in control of your finances at all times, not someone else. Collateralization and compounding interest works hand in hand when you position your savings correctly. What I'm about to teach you is how you can create true wealth, not just save money. The definition found in the dictionary that defines collateralization is providing something of equal or greater value as collateral for a loan. When you use an Index Universal Life contract to protect and grow your money, it provides a very unique feature no other financial product provides. The cash accumulated inside the policy can be used as collateral to be borrowed against from a bank or even from the insurance company that is managing your cash. Why is this feature so important and such a big advantage? First of all, you don't have to jump through all the normal hoops from a bank to borrow money when you need immediate access to your cash. And second, because you never interrupt the compounding growth on your cash accumulated inside of your Index Universal Life policy. One of the most powerful things you can do to create wealth is to never interrupt compounding interest on your savings. By collateralizing your savings for major purchases instead of spending it, you never interrupt the compounding interest process. So for the earlier example, your loan could be collateralized by the cash value inside your Index Universal Life policy. Now hold on for a second. Don't tune me out, because I'm pretty sure I know what you're thinking. Most people who want to keep their money protected and growing have an adverse reaction to the word loan. To them it means debt, and no one likes debt or wants debt. And it took me a bit of studying to figure out how these policy loans work and how I could use them to my advantage. Once I did, I knew policy loans from the Index Universal Life contract could be an amazing feature that anyone could and should be using before borrowing money from a bank the traditional way. Let's go back to our previous example. What if you could be the one in control? Let's say you've saved $50,000 in your Index Universal Life contract, and it's protected from risk and it's growing right along, and you need that $15,000 for that piece of equipment. You can go down to your local bank and say, I'd like to borrow $15,000. And the bank's going to say, for what? You don't even have to tell them what the loan is for if you don't want to. You continue your conversation with the banker and you say, I have my own cash growing within an Index Universal Life contract. My returns have been quite well, so I don't want to disturb the growth of my money. What I want to know from the bank is, what interest rate will you charge to loan me the $15,000 if you can collateralize the loan against my cash? Most banks will fall all over themselves to loan money using your cash as collateral. What is so enticing to a bank is they can place a collateral assignment for 100% of the loan against the cash value inside your life insurance policy with a simple letter to the insurance company. To the bank, this is the most secure loan that they can place. If you ever default on paying the bank back, they can take the cash from the policy. If you die before you pay their loan back, they get the money first from the death benefit. When you control liquid cash growing in a compounded environment, that cash is king. You can negotiate what interest rate you pay to collateralize those funds. For most banks, your interest rate will be the lowest rate that they offer at the time. In today's current economic environment, banks are willing to loan cash on cash for around 3% or less. You can get a line of credit from your bank for the $15,000 you need for your piece of equipment and pay only the monthly interest on the borrowed funds, or pay back whatever you want on a monthly basis to pay down the line. All along, your $50,000 of cash inside your life policy is participating in the annual index gains with no risk. If the Index Universal Life policy credits 10% the next year, your cash grows by 10% while using the bank's money for 3% or less. If the index ends up flat and you don't earn anything on your cash that year, you still control your cash and it costs you 3% for that control. Keep in mind, just 1 year of a 10% gain in the Index Universal Life would cover 3 years of interest you would owe the bank to use their money. If the economic environment changes and the bank needs to charge more than 5% to collateralize your cash in your policy, the insurance company managing your cash will collateralize your cash value in your policy for a rate normally around 5%. And this is a contractual guaranteed rate that can never change for the life of the policy. So you have options to allow your cash to continue to compound in your Index Universal Life policy. You can choose not to collateralize it and just let it grow. You can use a bank to collateralize it and still let it grow. Or you can use the insurance company's guaranteed loan rate and also let it grow. Do you see what all these options have in common? You never interrupt compounding. You now can get the equipment that you need, when you need it, from whomever you want to get it from. You decide when, how, and even if you want to pay the loan back. Now, what I'm about to share with you could have a huge impact on your family and your children or your grandchildren's future. Carefully planning your children's college funding could be the difference between them going to the school of their choice and having the career of their dreams, or having to settle for less because the money wasn't there. Or worse yet, coming out of college loaded down with mountains of student debt. Like the business owner, if you had a funded Index Universal Life policy, you could collateralize the cash and pay for your children's education, eliminate the need to acquire student loans, and without interrupting the compounding of your money. In 2008, when the market crashed, families across America discovered that the 529 Educational Savings Plan wasn't as good as they thought it was or could be. Why? Because the money inside of a 529 plan has too much risk exposure. This caused many of these families to lose a lot of their 529 savings, and they were forced to go to different colleges than what they originally planned for. Unlike a 529 plan, the cash inside of an Index Universal Life insurance contract is in a true compounding environment that is protected and continues to grow. If the market crashes like 2008, you're not going to lose any money. If you start early enough, you could have all the money you need to pay for your children's education, and then you and only you determine how and when you're going to pay it back. Don't just take it from me. Right below this video is a link to an article that was featured in the Morning Star. If you read that article, you'll discover 529 plans lost a tremendous amount of money, one as much as 35% during 2008. Due to the severity of the Great Recession, which could happen again in the near future, you simply cannot afford to put money into a 529 plan if you're a risk-averse person and paying for your child's education is something that is important to you. At the end of the day, the government actually controls the 529 plans just like they do your qualified plan. They can change the rules whenever they want. The money managers have control of the funds, and government has penalties if you use the money in a different way, not to mention the unknown. The collateralization feature of an Index Universal Life contract doesn't just work for business and college planning. What if you want to buy a boat for family to enjoy with your friends at the lake every summer? Could you use the loan provision in an Index Universal Life contract to purchase a boat or other recreational family toys? The answer is absolutely yes. What about a second home for your family to enjoy during holidays or vacations in the mountains or on the beach? The answer again is yes. You see, when you take a policy loan from your Index Universal Life contract, you have the option to pay back the loan, pay back just the annual interest on the loan, or never pay it back. If you choose never to pay the loan back, the borrowed dollars and the accumulated interest on the loan will be paid back to the insurance carrier from the death benefit when you pass away. Let me give you an example. You have been diligent about your savings, and after 15 years, you've accumulated a cash value of, say, $100,000. You've decided to pay for your children's education with some of these funds and you borrow $50,000 for tuition. You later determine paying back the $50,000 loan would put you in a financial distress, so you decide not to pay the loan back. When you pass away, your policy death benefit will be less than the amount of the loan plus any accrued interest owed to the insurance company. So if your death benefit is $500,000, the death benefit will be reduced by the $50,000 loan plus whatever amount of interest has accrued. If the interest is $10,000 and the loan is $50,000, then your beneficiary will receive $440,000 of the $500,000 as a tax-free death benefit. I hope you're starting to get excited about actually taking control of your own financial future by utilizing the incredible benefits the Index Universal Life policy can provide for you. Now, if that wasn't good enough, let me explain to you how to make your money work overtime. Business owners and real estate investors always love this discussion. Let's say you have a capital account you use to make business deals or buy real estate. And that account has a balance of $250,000, and you've averaged a 25% rate of return on all your business real estate deals in the past. This is a great return on your investment dollars, I agree. So why would you ever consider putting this $250,000 of capital in an Index Universal Life policy that has averaged an 8% tax-free return over the past 20 years? I've had that question asked to me hundreds of times. So I built a calculator specifically to demonstrate the advantages of collateralization of capital inside an Index Universal Life policy. We're going to make some assumptions for this illustration. I will assume you make an average of 25% return on all your investments from your capital account. I also am going to assume you're in a 28% federal tax bracket. Using these assumptions, if you invest your $250,000 this year, by the end of the year, you would have earned 25% interest on your $250,000 or $62,500. You have to pay your short-term capital gains, which is your ordinary income tax bracket rate of 28% or $17,500, leaving you a net gain that year of $45,000. This is going to give you a net rate of return on investment of 18%. A great return on investment in anyone's book. Let's look how this works going through the Index Universal Life collateralization process. Assuming all of your $250,000 of capital is inside the cash value of the Index Universal Life contract, and we can use the insurance company's guaranteed loan rate of 5% to use the money to make our capital investment, I will use a conservative 7% return for the Index Universal Life crediting rate for the year. Now, you will receive your normal 25% return on your investment, but this time you have to pay the insurance company 5% to use their $250,000 while your collateralized $250,000 is still earning interest in the Index Universal Life. So that is a cost of 5% on the $250,000 or $12,500. You will now pay taxes on $50,000, not $62,500, as in the previous scenario, because you get the tax deduction on investment interest paid. So your tax liability is $14,000, not $17,500. Your net earnings is $36,000 after you pay the tax and the loan interest. Now, add the credited earnings from your Index Universal Life policy of the 7% or $17,500. Because the $17,500 is not taxable, you get to add the entire $17,500 to your gains. That brings your total earnings for the year to $53,500. Almost a 19% increase in your overall return by using the Index Universal Life policy collateral feature to protect and grow your money. Do this over a 10-year period, and you increase your overall return on your $250,000 by an additional $181,000. This is truly building wealth. What I want you to understand is the conservative tax-free compounding rate of return within the Index Universal Life policy is a great rate of return for a financial product that protects and grows your money. But one of the most powerful and misunderstood features of this product is your ability to use your money for another opportunity and never interrupt the compounding on your original dollars when you want to use them for an investment or a capital purchase. On top of all this, You get the life insurance benefit to protect your family if you prematurely die. What if your local bank is offering a lower percentage rate on their loans than the insurance company is charging? Banks are willing to collateralize cash inside of a life insurance contract for capital purchases. In today's economic environment, the cost to borrow funds from a bank may be cheaper than using the insurance carrier's guaranteed loan provision. Most banks are charging around 2 to 3% for a line of credit that collateralizes the cash in a life insurance policy. The insurance companies are charging 5 to 6% for their loan rate. If your money inside the Index Universal Life policy is earning an average of 7 to 8%, and you're okay with paying at least the monthly interest to the bank to use their credit line, you could do well by using the bank's money at 2 to 3%. That allows your money to continue to grow and compound while you're using it to make a capital purchase. By managing your money this way, it is doing two things at once. It is still growing in a compounded environment, and you're using it to buy something that you want or you need. I've only scratched the surface here, but I'll bet if you're like most people, your mind is swimming with possibilities. In my book on page 77 through page 82, I cover a lot more of the details on collateralization. So be sure to study that information because this is a powerful strategy that you can use to create true wealth for your future.